Stocks and bonds. You've probably heard that bonds are more conservative than stocks. And that being true, it would make sense that these allocations would plot out on the line like this, right? All stocks is the most aggressive with the best return potential, and all bonds is the most conservative investment with lower long-term returns. And it would make sense that a 50-50 portfolio between the two would be here in the middle. 80-20 mix about right here, and a 20-80 mix here. Well, that's not actually how it works. Welcome to the RhinoInvestor.com educational series. Like and subscribe to charge along with us. The long-term chart of stocks and bonds, when either by themselves or mixed together, looks a little more like this. 100% stocks is still up here in the upper right, but it's way up there. Highest risk, but also the highest return potential over time. I would consider this your average aggressive investor. 100% bonds is down here, but before I tell you what's in the left-hand side that's more conservative, let's finish plotting out the other allocations. 80-20 goes about right here, actually quite a bit less than you might think than the 100% stock allocation, and considered to be a traditional growth investor. A 60-40 allocation is actually what goes more in the middle of the plot. This would be your moderate investor. Then I'll skip to the big question. What is the most conservative asset allocation? 20% stock, 80% bonds. Well, that's interesting. So, what's left in this area? What has the same long-term risk profile as 100% bonds, but much better return potential? The 50-50 allocation. I refer to this as being efficiently balanced. I use this chart to see if my clients are invested the way they think they are. Because if I were to ask them to plot a chart of risk and return in different allocations, I get that first chart every time. It's just what we think makes logical sense. But bonds can be volatile too. And if we just add a dash of stocks to those bonds, we actually not only have a better return profile, but a lower risk profile as well for the conservative investor. And for my clients who want to be growth-oriented but are conservative at heart, the 50-50 allocation is a traditionally more efficiently balanced way to go. On the right side, I also try to encourage a dash of bonds to most growth investors. Except for the younger investor who has decades to invest or the very aggressive in nature, most growth investors feel more comfortable with a lower risk profile and end up with a return potential that meets their needs. Now that you've seen this chart, you can tell your neighbors that you know a little something about modern portfolio theory and the efficient frontier of investing. The concept started in part from Harry Markowitz, who won the Nobel Prize in Economics in 1952 and are still the building blocks to investing today. The three basics of his theory are: if given a choice, most people would opt for the least risky way to achieve their financial goals. A portfolio's total return and risk profile is more important than the risk and return profile of any individual investment. Markets are efficient because all people have access to market information at the same time, so securities are never priced too high or too low for what they are worth. Oh goodness. Nope. Friends, if humans were 100% rational, Vegas would not be thriving. There would be no market bubbles, no speculation, no irrational exuberance. And yet, there is. One can argue that markets are efficient over time, but that inefficiency and irrationality in the short run can wreak havoc on our investment returns. To illustrate this, let's look at the case of Peter Lynch. He ran the Fidelity Magellan Fund for 13 years, and in that time, he produced an incredible 29% average annualized return. Fidelity at one point did some research on when investors were buying and selling the fund and what their personal returns ended up being. Peter learned that the average fund holder at his Magellan Fund actually lost money at a time when all you had to do was hold on while he did all the work. Humans are actually very bad at predicting how they'll react in real time when markets are up and down extreme amounts. It can be harder than we think it will be to keep our emotions in check when the markets are fluctuating. keep going on to video 2 in this series and learn the pitfalls we can avoid with behavioral finance. It's another step in the right direction to being a rhino investor. See you there.